appreciate your patience. Thank you so much for waiting. We are live both on Zoom as well as YouTube. So for those on Zoom, if you have any questions, please feel free to use the Q&A button that you see at the bottom of your screen. For those on YouTube, feel free to post your questions in the chat section, and my colleagues will actually be helping me to moderate the questions. So once again, thank you so much for joining us for tonight's webinar. So for a lot of you here that's joining us tonight, you may be holding a lot of cash, unsure of what to do with the excess that you may have, or you may have funds in perhaps cash management products or locked up in a fixed deposit or equivalent product like the Stashaway Simple Guarantee in Singapore that's probably approaching maturity or has matured. So as you consider the next steps with these funds, know that while holding cash is great, investing these funds with a long-term mindset is equally, if not more important. So if you're currently exploring your options, you have never invested before, or you would just like to learn more about how to frame your mindset around risk, or if you need some guidance navigating the Stashaway app to set up portfolios, I do hope that today's webinar will be able to help shed some light around this. So again, welcome to today's webinar. Before we move on, here's a brief look at our agenda today. So we will start with a brief intro into Stashaway. Then we'll talk about risks, how to think about it, and why risk management is important. Then we will be exploring some core principles that you should keep in mind when constructing a portfolio for long-term investing. And then obviously we'll move on to the most important and exciting part, which is a short demo of our platform. I'll run through how you can create a portfolio during the demo, how to set up a deposit or recurring deposit, and some key features of our platform. So during the demo, I would highly encourage all of you, if you are able to actually access the app while watching this webinar, to actually follow along, just so that you can also sort of get familiar. Again, if you have any questions at any point in time, please feel free, if you're on Zoom, to use the Q&A function button. If you're watching on YouTube, please feel free to use the chat box function. So throughout the whole session, my colleagues and I will actually be moderating and answering questions where we can. Otherwise, we will actually get to the questions at the end of the webinar. So very briefly, in case you are new to Stashaway, let me share a quick introduction of us. So we were founded in 2016 in Singapore, where we essentially were the first of its kind, a digital wealth platform and investment platform. Since our launch, we've grown a lot and have also expanded into 4 other geographies. So this includes Malaysia, the UAE, Hong Kong, as well as Thailand. So we're licensed in 5 different jurisdictions. And as you can see here on your screen, we are backed by some of the biggest investors in the world, including Sequoia, Fidelity, as well as Hamilton Lane. Along the way, we've also collected multiple accolades, with the most recent last year being named one of the high growth companies in Asia Pac by Financial Times, as well as being one of CNBC's top 200 global fintech companies. Since launch, we have also released multiple products across all our platforms for our users. So here is a very high level overview of all that we have on our platform. We do offer different products in different regions, but there is still an overlap of products. So under cash management, the projected yields that you see differ depending on the region you're in. And we currently have the simple guaranteed portfolios, which are our fixed deposit equivalent on our Singapore platform. Again, if you do have any questions about our products, or if you want more clarity, once again, feel to use the Q&A function, and our team will respond where they can. So before we start, I do want to take some time to reflect a little bit about what we know about investing, or rather what you know about investing. So let's imagine that you currently have $10,000 today, and you want to grow the sum. So for those who are on Zoom, I do want to ask you to use the chat function. How confident would you feel in your ability to invest that sum of cash today if you had $10,000? Let me just switch the chat function on. Okay, Jasmine. Jasmine rates herself as a 3. Okay. It's okay. We're all here to learn today, and I hope that today's webinar will help provide some clarity. Okay, we have some fives. Okay, this is actually good because what we see is we actually see sort of like a spectrum of confidence from 3 all the way to 7, 8. So I know that the idea of investing itself is already intimidating for some. And essentially, while a simple Google search may search you when you long answers, some not necessarily easy to understand. In reality, being smart with money does not actually require you to be a genius. And a lot of complex sounding financial principles, terms, definitions, they are actually pretty simple. So before I actually move on, a different question. So, for those who have yet to start investing, what is currently the biggest blocker that's holding you back from investing and essentially taking the first step? And for those who are already investors, just kind of go back in time, right? So, before you started, what do you remember being your biggest fear? You just give people some time. I'm seeing some answers coming in, not making an informed enough decision. Yeah. Okay. Yeah. So I'm seeing some pretty interesting answers here. I see that the sort of what a similar theme from all the answers that are coming is predominantly, I realize I don't have enough resource. I didn't know how to start. It's a little bit scary, and that I understand, right? So let's just move on to the idea of what is investing. So as I mentioned before, the idea itself is already pretty intimidating. There are a lot of complex terms and noise, especially when you just type in the simple Google search. There's just a lot of things in the internet that can really easily scare you. But what is investing? So, investing is putting your money into assets with the expectation that your money will grow. That's it. It is really that simple. The internet does scare people. A lot of news articles, a lot of information out there can be quite scary. But just remember that investing is putting your money into an asset or assets with the expectation that your money will grow. So, before investing, it is important that you determine your risk tolerance. So, there are a few factors to consider when determining your risk level. The three core factors for you to consider are your investment goals, time horizon, and personal comfort with market volatility. So, this is a fundamental step in creating an investment strategy that suits your unique circumstance and allows you to build wealth while managing your risks effectively. So, depending on your risk tolerance, you'd fall somewhere in between the spectrum of risks. It is generally classified into these three categories. So, that's the conservative, the moderate, as well as aggressive. So, if you're someone who is generally a little bit more risk averse, or your current circumstance only allows you to expose yourself to lower risk assets, then it's probably best for you to take a more conservative stance when investing. So, an example of conservative portfolios includes cash funds or bond funds. If you're okay with taking some risks, but would like some balance in your portfolio to smoothen out any sort of volatility that you might actually experience. And the reality is, when we invest, there will always be volatility. Then perhaps you'd be classified as someone who's okay with taking slightly more risk. So you'll probably fall in the moderate category, moderate risk category. So a balanced portfolio in the moderate risk category is when you have an equal exposure to assets like bonds or assets that give some form of yield, as well as gives you an equal exposure to higher risk assets like equities. If you're an individual with slightly more experience in investing, so you understand the markets, you're comfortable with market volatility, meaning, if you open your investment portfolios today, you see that it's down 5% or 10%, you know that you're investing for the long term. So in it, you're still comfortable. then you're likely classified as a more aggressive investor. So your portfolio mix would likely have a much higher exposure to equities and higher risk assets, and maybe a lower exposure to fixed income, like bonds or commodities. So over here, oops. So over here, this is essentially a more expanded version of what I just mentioned. So again, as I had said earlier on, you all investors would fall into either one of these categories. Depending on the categories that you perceive yourself to be in, you would likely be comfortable investing in different assets. So why is it important to understand where you fall on the risk management spectrum and your personal risk tolerance? So there are several factors as this reflects your ability and willingness to accept investment risk. So by understanding your personal comfort level, you can align your investment choices and ensure that you don't take on more risk than you can handle. This is both emotionally as well as financially. So this is also so you'll be able to achieve any sort of financial goals and objectives that you had set out for yourself. Markets can be extremely volatile. Understanding your risk tolerance can help you avoid making impulsive decisions during any sort of market downturns or when you're faced with unexpected losses. You will essentially also be investing with a much, much greater peace of mind, knowing that your portfolio is aligned with your risk comfort zone. Emotional investing leads to costly mistakes. Lastly, when you have a well-matched risk level, it contributes to your long-term investment success. So when you are comfortable or when you are investing in a risk that is comfortable for yourself, it helps you stay committed to your investment strategy even when markets fluctuate. So this increases the likelihood of you achieving your financial goals over time. Again, I do understand that perhaps some of this might be quite complex or might be a little bit technical for some. Feel free again, once again, to use the Q&A function button if you have any questions, and we'll get to that at the end of the webinar. So moving on, here is some data that shows why having an appropriate risk management strategy can help with long-term success of your investment. So when you're in an appropriate risk level, when you're investing comfortably, when you're comfortable, when you are invested with a peace of mind, you will be comfortable staying invested through any sort of volatility. So what you see here in this diagram is that if you had invested $10,000 in the S&P 500, kept your money invested in the markets, even through the most volatile period in recent memory, as well as COVID-19 itself, you'd still have made roughly about 650% in returns. And this is all without lifting a figure. And what about timing the market? So we hear a lot about people waiting for the quote unquote right time to enter the market or exit the market. So even if you've missed only the 10 best days in a market, you'd have already lost out on about 350% of potential returns. So when you zoom out, where we're trying to get at is that history does make it plain to see that by keeping your cash invested, you're letting your money grow alongside the markets in a consistent manner. So where I'm getting at is we should all be an investor. As an investor, obviously you do need more patience and discipline, and not get too affected by any sort of short-term fluctuation you might see in your investments. So you should definitely stay focused on the path toward your financial goal. Risk tolerance of investors also tend to be slightly lower, and investors are usually more interested in assets that have strong fundamentals. So we're not the trading kind. We're not the kind that sits in front of the market and watch the chart go up and down on a daily basis, right? So when you invest in assets that have strong fundamentals, this essentially provides a sustainable return for your portfolio. But this does not mean that as an investor, you don't take any risks. You do. Investors take smart risks. So what you do is, as an investor, you tune out a lot of the noise that surrounds the market, and you just stay invested through all the volatility and top up cash as you can, as and when you can, back into your portfolio. Just remember that when it comes to investing, there is really no one-size-fits-all approach. It's always a one-size-fits-one. So as individuals, our goals, our time horizon, and most importantly, our risk tolerance differs. So even between individuals who seem like they have a similar profile, there will be a difference in investment preferences. At Stashaway, we do believe in taking a longer-term view when investing. So as an investor, given that you would usually have a longer time horizon, This means exposing yourself to fundamentally strong assets that you believe will steadily approach over time. There will be less emotional stress that comes with rapid trading decisions and market swings. And you'll also be able to have a good night's sleep without worrying too much about how your portfolio is doing. So let's look now at constructing a solid portfolio through an asset allocation strategy. So what does this mean? So having an asset allocation strategy means spreading your investment among different asset classes to essentially achieve a balance between risk and potential returns. So the goal is to minimize risk to maximize your potential returns. Asset allocation strategies have been proven to be more effective in generating positive returns 80% of the time relative to individual stock selection due to the fact that different asset classes are not perfectly correlated. As an example, usually the equity markets and the bond markets tend to move inverse to each other. So if there comes a year when equity markets are extremely volatile, they seem to be trending downwards. Bond markets typically are fairly stable, or they trend upwards. So that essentially helps to sort of close the gap between the downtrend and the uptrend, the downtrend of your portfolio. So this means that the performance does not move up and down by the same amount at any given time. So as a result, a portfolio does benefit from investing across different asset classes and through diversification within the asset class itself. So an investor can optimize the portfolio's risk-adjusted returns with the sort of diversification. So the goal of an asset allocation strategy is to create a diversified portfolio that aligns with your financial objectives, your risk tolerance, as well as your investment timeline. So what the three important factors that I spoke about earlier on. So studies have also shown that the majority of portfolio returns does come from asset allocation. And at the end of the day, it's actually the economy, not the daily markets that we see, but the general macroeconomy that drives medium to long-term returns. So when I talk about assets, this can be divided into a few different categories. And these, the ones you see on your screen right now, are some of the more common ones. So corporate as well as government bonds are generally less risky and are suitable for individuals who are less comfortable with taking any sort of high risk investments. Bonds are actually debt securities. So they're debt securities that are issued either by entities or the government, and the ones that are issued by the government are what we call government bonds. And these debt securities are issued to raise capital. So when you invest in a bond, you are essentially lending money. As an investor in a bond, you are lending money to the issuer in exchange for periodic interest payments and the return on the bond's face value, or as we call it, principal at a specified future date, known as the maturity date. So these are the sort of the terms that you do see on fact sheets when you buy bonds. So I hope that I was, with this, if you were unfamiliar, that you have some clarity right now. So bond yields are also influenced by several factors, right? So this includes prevailing interest rates, credit risk. So when I say credit risk, this is the risk of default by the issuer of the bond, the time to maturity, and market conditions. When interest rate rises, bond prices tend to fall, and this leads to an increase in yields and vice versa. So this is all quite technical. We will not be getting into that today. But again, if this is something that you feel you would be interested in, just let our team know, and we can definitely have a separate session for this and address this in more detail, obviously for your educational benefit. The second asset that we have here are commodities. So commodities can be a valuable addition to a diversified investment portfolio. Some of the more popular commodities that we know of are gold and silver. And gold and silver both have a history of serving as hedges against inflation. So when the value of currencies decline due to inflation, the prices of these precious metals often rise, which preserves the purchasing power. So during times of any sort of economic turmoil or market instability, commodities can act as a safe haven, and investors often flock to commodities like gold and oil. I'm sure we've all heard of this as a store of value when other assets are essentially under pressure. So there are different ways to get exposure to commodities. You can gain exposure through exchange traded funds or ETFs, physical commodities like gold or silver bars, and perhaps through options or futures contracts, which allows you as an individual or an investor to speculate on price movements of the commodity. So there are certain commodities like gold that are viewed as a safe haven and is of relatively lower risk as an investment. But the way you choose to gain exposure to the commodity also depends on your risk profile. So for example, buying a physical gold bar on an ETF that tracks gold prices, it exposes you to much lower risk compared to buying gold future on an exchange, for example. Again, this is something we're not getting into too much detail for today. I just would like to highlight the asset classes here as good to know for yourself. So moving on, we have real estate and real estate investment trusts or REITs. Perhaps you have seen this listed on various stock exchanges. They are two related but distinct ways to invest in the real estate market. So when you invest in real estate directly, you are purchasing a physical property, such as maybe a residential home, an apartment, a commercial building, or a land. You become an owner of these properties, and your return on investment typically comes from any sort of rental income and property appreciation. REITs, on the other hand, so REITs stand for Real Estate Investment Trusts. They are investment vehicles that pools capital from multiple investors. So they are typically listed on stock exchanges to purchase and manage income-producing real estate properties. So they operate similar to mutual funds, but they do focus on real estate assets. So REITs can invest in various types of properties. So this includes commercial, so office buildings, shopping centers, or residentials, apartments, and other sort of properties that we have around us. So real estate investments in general are far less liquid and often, as you and I probably know, require substantial capital upfront, while REITs definitely offer, an easier access to cash through the sale of shares on stock exchanges, which means that you can invest in REITs with a smaller initial investment. So lastly, we have equities or stocks as it's popularly known. So when you own an equity, you hold a portion of the company's ownership and you become a shareholder. So they offer the potential for wealth accumulation over time, but obviously this also comes with risk. So depending on the sector or company that you do decide to invest in, the risk that you will be exposing yourself to will vary. So you can, however, get a much, much more diversified and lower risk exposure via ETFs or exchange traded funds. So we will actually be diving into the world of ETFs in our next webinar. So stay tuned for that if you are interested. So moving on, I have also spoken early on about timelines and how it does relate to risk. So what we're looking at now are two different assets with varying risk levels. So if you can see the darker line, it actually represents equities. So that's much, much higher risk. And the lighter line, the line in light blue is actually represents fixed income. So if you can see with the line that represents fixed income or the lighter blue line on your screen, tends to be much more stable with a slower appreciation rate. While equities, which are generally, as I mentioned, higher risk, experiences much, much more volatility. But it does see its appreciation increase significantly in the longer term. So let's look at how we can put this together with goals of different time horizons. Let's just help make sense of this graph that you see in front of you. So here we see two different goals A and goals B. Goals A is shorter term and goal B is much longer term. So what you see are also the two investment options from before. The darker line, which represents equities, slightly more volatile, and the light blue line, which represents fixed income, which is slightly stabler. So as you can see, if you had a goal that is of a shorter timeline like goal A, it would be wise to invest in steadier fixed income assets to avoid the volatility that equities present. You see there's a sharp drop in equities where goal A ends. So imagine if you had to withdraw your money at that point in time. However, if you had a much longer time horizon like goal B, you can potentially expose yourself to a much higher risk investment like equities. And there may be volatility in the short term, but it does not last forever. So this is why your financial goal time horizon plays an incredibly important role in determining your risk tolerance level. Let's look at two different examples here. So we have Rachel, who is someone willing to take more risk, and Mark, who is a little bit more conservative. So as you can see, Rachel's portfolio is comprised of more high-risk assets like equities, but she also ensures that she has exposure to bonds and commodities so that she can smoothen out her returns during any sort of market volatility. For someone like Mark, who's slightly more conservative, he will be more comfortable with a higher portfolio exposure to bonds and commodities with a small exposure to equities. So right here are two examples of how you can have an asset allocation strategy in your personal portfolios to ensure that it fits your risk profile and time horizon. So while all these words and sentences I've spewed may sound very long-winded and perhaps a little bit confusing, the best way to really understand this is to have tried something yourself. And honestly, our Stashaway platform has made it very easy for you to explore. So with that, what I'll do is we will move on to a demo of our app. So how we're going to do this is I'm actually going to share my screen from my phone and show you my app personally as well. For those of you who have joined us, I would encourage you to also, if possible, turn on your screen, your app, sorry, and sort of follow along if you have not actually created. And along the way, I will also be explaining things so that it's easier for everyone to sort of get familiar as well. So just give me a moment as I set up my phone. Again, if you have any questions, please do feel free to ask at any time. So give me 1 second. Okay. Should be able to see my screen. All right. Okay, so what you see here in front of you is actually our app, and this is my actual portfolio. So as you can see, I have multiple portfolios, sorry, including some cash management portfolios. So how do we actually, if you have not already tried, how do we actually create portfolios here on our platform? Okay, let me just move this aside. So what you can do, if you see at the top, you see deposit, create, learn, and refer. If you click the plus sign, which is to create, it will actually lead you. So I'm actually on the Singapore platform. So I do have an option to deposit from our Singapore, supplementary retirement scheme account. But for now, I'm just going for my personal bank account. It will actually lead you to this page where you will see two of our currently our offerings, which is Simple Guaranteed and General Investing by BlackRock. So General Investing by BlackRock is basically portfolios curated by our partner BlackRock, by BlackRock, who we have partnered with. But to go for General Investing by Stashaway, which is curated by Stashaway's own investment team, pick from a range of investment strategies. So from there, it will lead you to this page where you will see General Investing powered by Stashaway. So click on that. And you will actually be led to this page. So core essentially are portfolios that are of lower to medium risk. So what SRI essentially means, the Stashaway Risk Index, is that at any given year, even through the most volatile period, there's only a 1% chance that you will lose more than the risk index year. So as an example, if I had chosen to expose myself or to create a portfolio with a Stashaway risk index of 16%, that means at any given year, through market volatility, there's only a 1% chance that I'll lose more than 16%. That means if for every $1 invested, there's a 1% chance that I might lose more than 16 cents. Or, for every $100 invested, there's only a 1% chance that I might lose more than $16. So where I'm going with this is that you need to make sure that you are comfortable with taking this risk, especially if you go toward the higher risk. So one of our highest risk portfolio is actually 36%. So let's say, you would like to expose yourself to higher risk, you would like to take higher risk because there is a potential of you gaining higher returns given the higher exposure to equities. You must be comfortable with the fact that there could potentially be a time when every $100 you invest, you might lose more than $36. So if that's something that you're unable to accept, or if that's something that you are not comfortable with, then I would highly suggest that you pick a slightly lower risk portfolio to start with. So let's just continue from here. So let's just assume I decide to start a portfolio with a statutory risk index of 30%. Click continue. So it would actually show up here. So general investing 3, that is actually the new portfolio that I had just started. So you click I'm done reviewing. It'll take you straight to your deposit plans. So what you can do is right now we have the option. Actually, if you're in Malaysia, we have a direct debit option. Singapore, we have e-Giro. If you're in the UAE, there's an option for lean. What happens is that it allows you to do recurring deposits from your bank account into specific portfolios that you had set up to accept the recurring deposits. So recurring deposits actually allows you to dollar cost average into your portfolio. Dollar cost average is simply the act of depositing money and buying assets regardless of the price, because at the end of the day, it's not about timing the market. It's a time in the market that's important for your investment. So I will actually just exit here for now to just show you on the platform, on the homepage. So if you see General Investing 3, that is actually the new portfolio that we had just set up. So let's just say right now you had set up these portfolios and you would like to deposit money in. How do you go about doing this? So what you can do is you can click deposit. Sorry, if you go down, so invest. Okay, if you click deposit, you see that you have the option to deposit, transfer, withdraw. So what you can do is you can actually click deposit, go to perhaps a bank transfer if you'd like to at this point in time. Set up a one-time deposit. Click the local currency or US dollar. And scroll to that specific portfolio, which is at this juncture, General Investing 3, which is what I had just set up, and put in the amount that you would like to deposit. From here, you would actually be led to the next page. We will then give you the account details of how you can transfer funds into your stashaway portfolio, as well as your unique reference code. So this is very, very important that each individual account has a unique reference code that you should definitely put in your bank transfer. Please do not remember to do that, so that in the back end, our system can actually match the funds that come in to your specific portfolio. Okay, so this is just a brief outline on how you can deposit. Another option is, say, for example, you already have money in your cash management, your simple account. In Singapore, if you have money in your Simple Plus account, what you can do is you can actually also click transfer. And you can actually set up recurring transfers from your Simple account or your Simple Plus account in Singapore. So for a lot of us, we use Simple or Simple Plus as a form and as an alternative to our savings or current account because of the yield that you are entitled, that because of the projected yield that our cash management portfolios actually offer. So say, for example, if you're an individual that has a fairly decent sum or a fairly large sum in your cash management account, you can opt to set up monthly recurring transfers from Simple to your investment portfolios, in this instance, general investing portfolios. And you can set up the frequency and the amount. And you can also choose to cancel it when you want or change the amount or the frequency as and when you like. So this is actually a good alternative to recurring deposits in your bank account if you so choose to put lump sums into your Simple and transfer from Simple, or set up a recurring deposit from Simple to general investing. So that's also an option. Another option is obviously you can do transfers in between portfolios. So say, for example, you realize you have multiple general investing portfolios for whatever reason, you would like to consolidate that, or you would like to just set up a one-time transfer from Simple. You can also do that. You know, if you feel like you have excess cash in Simple, you can also choose to just do a one-time large lump sum transfer from Simple into your general investing if you so choose to do so. So this is actually a high-level view of how to create as well as transfer. Let me just show you an example of what you will see once your portfolio is set up. So this is actually a live portfolio of mine that I do very, very diligently do recurring transfers into. So as you can see, even through the volatility, my portfolio has trended upwards, which is great. That's also because I do a lot of DCA. So when you do more consistent DCAs, let me just show you how it'll look like. The chart would actually look something like this, where you can see the green line is my deposits and the blue line is actually the market trending up. So even during market drops, so as you can see here, there was a slight market dip. I don't know if you can see, but regardless of it, in the long run, when you zoom out, markets actually still continue to trend upwards. So this is why we say that it's extremely, extremely important for you to take a longer term view, because in the short term, there will always be volatility. But when you zoom out, markets always trend upwards. So this is where it's beneficial for you to do DCA, to dollar cost average in, to obviously take a longer term view on the assets that you're investing in, and make sure that at the end of the day, you're investing in things that you are comfortable with. Yes, so this is actually just a high level overview of our platform, how to create an account, how to perhaps do transfers in. I will now actually open the floor to questions. If anyone has any questions they'd like to ask, let me just stop sharing my screen here and I will go back to our slides. If there's anything that anyone wants me to kind of run over again, if there's anything that anybody has further questions on, I'll be more than happy to actually answer them right now. Again, please feel free to use the Q&A function button. If you're on YouTube, please feel free to use the chat box. My colleagues will actually help me moderate the questions. And also, just to help get you started, the QR code that you see here, if you scan it, we do have vouchers for free management of the first $50,000 that you actually deposit into your investing portfolio. So that's activated upon your niche deposit. So I'll just leave this here as a little treat for everyone who has joined us this evening. Once again, let me just give, we're actually ahead of time, but I will actually take any sort of questions that you may have. I'll just give it a few minutes. Yeah, so please, again, feel free to ask questions that you may have, whether it's about a platform, any sort of concept that I just ran through today. If you'd like me to go back, I'd be more than happy to do that. Okay, so we have a question from Anonymous. Okay, how to tell if the portfolio is profiting or is it just my recurring deposits? So you would actually be able to see the difference in between your deposits as well as the assets. As I showed early on, there will be a return widget for you to sort of gauge what your general returns are. The underlying assets are also trending upwards, so it's not just your deposits coming in. So there will be actually ways for you to tell where it's returns and where it's your deposit. So the chart that I shown early on, you do see the difference in terms of the green line that I showed was your deposits, and then there was a blue line, and that was basically your assets trending upwards. So you will be able to see the difference. So I hope that helps in that regard. Yeah, so thanks so much for your question. Okay, there's another question here. Is your app available for UK citizens, and do you offer a Sharia compliant asset? Okay, so if you are a UK citizen, and if you live in Singapore, it is available. You are also, if you don't actually live in Singapore, you can open an account on our Singapore platform. We do require some documents for KYC purposes. At this juncture, we don't have any sort of Sharia compliant assets, I believe. We are looking into this, so definitely stay tuned. This is something that we are actually looking to offer our users. Oh, Whitekin has a question. How do I create a single ETF type portfolio? Actually, really good question. So let me actually share my screen on my phone again so we can run through that really quickly. So that falls under our flex portfolios. Just give me a moment to share. on Zoom. Sorry, 1 second. Okay. All right. So you should be able to see my screen. Okay. Okay, so sorry, going back to Anonymous's question earlier on, let me just address that. So you'll be able to see, if you can see here on the chart, the green line is my net deposits, and the blue line is actually the movement of the assets. So you'll be able actually to see, you would actually be able to see the difference in between your deposit as well as the asset movement. Okay, now to Wykin's question is, how do I create a single ETF? So that's a really good question. We actually have a product called Flex, and what Flex allows you to do. So for the SRI general investing portfolios that I had just shared, just brought up and demonstrated how to create, those portfolios are curated by our investment team. As an investor in those portfolios, you will actually not be able to tweak or change the weightage of the assets in that portfolio. But to Wykin's question, which he has sent in the chat, you can actually create portfolios with single ETFs. So let me kind of run through how you can create that. So same thing, at the top you see deposit, create, learn, and refer. Click create. Choose where you want to deposit from. If you look at the bottom, there is customize a portfolio. Customize portfolio. So you can either choose to create a portfolio from scratch, or you can choose to start with a template portfolio. So in Wykin's term, he would like to actually, I guess in this regard, start a portfolio from scratch. But let me just run through the templates of portfolios first. So we do have 4 different portfolios for you to choose from at this point in time. So these are already created for your convenience. In this instance, you can actually click on these created portfolios. For example, if I would like a world tracking portfolio, click on this. And with Flex, you can actually change. Okay, this one is not an accurate representation because it only has one asset. But say, for example, you choose a portfolio with different assets, you can actually change the weightage depending on what you'd like to expose yourself to. So say, for example, you like the idea of having a portfolio with equities and bonds, and you like the composition of this portfolio that we had actually templated and curated for yourself. What you can do is you can actually just change this around to suit your need. So 60%, that means 39.4. And we have this here to make it easier for you to round up. So for example, this is something that you can do, and you can actually, the allocation there, it will do the math for you. So you don't have to think too hard about it. So this is one feature of Flex. Sorry, going back to Wykin's question, how do I create a single portfolio? So, okay, let me just start again. Create bank account, customize a portfolio, create a portfolio from scratch, continue. Here is where you would see all the ETFs that we have available for you to sort of create your own portfolio. So for example, SPY, which is the S&P 500. Here you go. The S&P 500 is here. So you can actually just, sorry, to earlier on question, we do have Sharia compliant ETFs for you if you'd like. And from here, there, you can create a single ETF portfolio. So I hope this answers your question, Wykin. Okay, so we have a question from YouTube. Hi, just an open question. Notice you have many portfolios. Any specific reason for that, considering that our GI portfolios are already very diversified? Yes, so good question. It's really just for everyone, because ultimately at the end of the day, it's good for you to have a diversity in your portfolios. I understand that the portfolios are already very diversified, But for example, our GI portfolios do not contain the S&P 500. It does not contain NASDAQ. So you might want perhaps a portfolio like a general investing portfolio, and you can then use Flex to add in perhaps the S&P 500 or the NASDAQ if you so choose. If, say, for example, if you're talking about the difference between the BlackRock general investing and statutory general investing, so the BlackRock general investing actually gives you a much, much, much wider and broader market exposure just because of the number of ETFs that are in the BlackRock portfolios. And it is also more active in nature because BlackRock does re-optimize a lot more frequently than we do. So for those who don't know or are not familiar, for Stashaway, we have a proprietary algorithm called ERA that's sort of running in the background. Well, not sort of, it is running in the background. That sort of takes into account market data, any sort of macroeconomic factors, any sort of movement in the markets, and tries to help our investment team make a decision about what economic cycle are we in, what potentially is good for our portfolios at any given time. So our stashaway portfolios are a lot more passive in nature. In fact, we're actually passive, and we don't actually have as much ETFs or assets in our portfolios. So while it's diversified, it does not give you as big a market exposure as BlackRock. So given BlackRock's broader market exposure, it also tends to be slightly higher risk than the standard stashaway portfolio. At the same time, we have Flex because we do understand that there are clients who would actually like the freedom and who would also like the ability to customize portfolios for themselves. And also for our flexible portfolios, unlike the brokerages, or if you have a brokerage account, for example, we do not charge fees on transactions. It's also a monthly or annual fee, anywhere from 0.2 to 0.8, depending on AUM. And this actually is way more convenient for people who like to do consistent depositing, consistent dollar cost averaging in, versus just constantly paying a transaction fee if they were to do that with their standard brokerage accounts. So in the long run, it actually works out to be much more economical. Cash management obviously is for people who are, a little bit more conservative at any point in time, at a specific point in time, and they would like to just hold cash while they wait to sort of deploy it into investment portfolios, or just because they feel that the projected yield that they're getting with us is much better than their bank accounts. So that's sort of the logic that's kind of going into how we actually think about our products. I mean, it's actually good feedback if, you asking this question, then it lets us know that, perhaps this is questions that our clients might have. But I hope I answered your question to a certain extent. Okay. Okay, so we have some questions. I've been starting small, but how do I increase my profits? Unable to deposit more due to low pay. So thanks for your question. There is a little bit of misconception, in my opinion, that you need a lot of money to make a lot of money. But the reality is it's all about getting into the habit and getting used to the discipline of investing. So starting small doesn't mean that you cannot make a lot of profits, right? If you are consistent and you are disciplined about your financial habits, if you're consistent and disciplined about when you actually put money in, if you set up, for example, a recurring deposit plan to deposit X amount of money every month at a certain time into your investment portfolios, at the end of the day, it will actually compound and give you bigger profits, especially if your timeline is anywhere from 10, 15 to 20 years. At the end of the day, when we invest, our goal is not just to invest for the short term. We want to invest for the long term. We want to be able to retire comfortably in 30, 40, maybe 50 years, depending on circumstance, obviously. So don't think of, if I start small, I will not be able to make big profits. You can. You need to give it time. The important thing is that you just don't stop. So let's say, this month, or you tell yourself, every month I'm going to put in $100. But, this month, because of circumstance, I had to spend a little bit more. So because of that, I can only put in $50. That's okay. As I mentioned, the key is to just not stop. So just keep going. Just get into the discipline and habit of putting money into your investments every month or when you're able to. Don't look at the number at the end of the day. Really, really just focus on your goals, put money in, and trust me, with compounding interest, everything will pay off in the long run. So take a longer term view, put money in, and stay disciplined about your financial habits. Okay, we have one here. Another question. One second, let me just open this. My Stashaway app is Malaysia version. I am wondering when does the Malaysia version can get the extra features such as Simple Plus, Simple Guaranteed, SG Income, Crypto, etc. Or can I apply Stashaway version if I'm not working and living there? So okay, let me just there's two parts to the question that's being asked. So this is coming from Waikin. He mentions that he's currently on the Stashaway Malaysian app. There are some features and products that are not available in Malaysia just yet. So we are aware of that. So this feedback is duly noted. We will definitely pass it on. So we are working on new products, and we always are working on new products. So just stay tuned. Hopefully, we'll be able to release these products to the other countries in the future. For the second question, can I apply a Stashaway Singapore account if I am not working or living there? Yes, you can. On Singapore, we are able to onboard people of different nationalities, even if you're not a Singapore taxpayer. So feel free to check out that version of the app when you can. Okay. Question from YouTube. Generally, how much are the ROI for ESG investment compared to other types? So we can't actually give you an exact figure, also because our ESG portfolios are actually made out of different ETFs. So at this point in time, it's very hard for us to really give you an exact indication of the ROI. But do know that the ESG portfolio is a little bit more volatile compared to our general investing portfolios. Could you actually share your email address or reach out to us support@stashaway.com? We will actually take this conversation offline so that we can actually understand your question a little bit more and give you a little bit more details to answer your question. Thank you for your advice. I will be more disciplined to deposit into my portfolios. No, thank you so much for joining us this evening. Thanks, Joaquin. Enjoy your dinner. Okay. Are there any more questions? If there aren't, then what I want to say is, first of all, thank you so much for joining us this evening. If you have any feedback for the session, please feel free to let us know at any time. You can reach our team at support@stashaway.com. We are having another webinar 2 weeks from today, I believe. So look out for that in your inbox. So in that webinar, we'll be doing a deeper dive into ETFs. And I'll be joined by a colleague of mine as well. So, we will actually be sharing a lot more information on ETFs. And I'll also be sharing a little bit more about general investing. So if that's something that interests you, feel free to join us in our next webinar. Look out for the Eventbrite invite in your inbox. And of course, as always, thank you so much for joining us this evening. We hope this has been helpful for you. If there's anything, please feel free to reach out to us at support@stashaway.com. Yeah, with that, I think we'll end it here today. Thank you, everybody. Good evening.